The Federal Reserve has been balancing inflation and job growth, and we're seeing inflation finally getting closer to the Fed's target. As the markets show signs of softening, it's all happening against the backdrop of slower economic growth. Recently, the Fed made a significant move by cutting interest rates, and this decision is especially important for older Americans and the economy as a whole. But what does this really mean for you? One major benefit of the Fed's rate cut is that borrowers, especially those 50 and older, may finally get some relief from the high interest rates we've seen in recent years. Lower interest rates mean cheaper borrowing costs, which can be a huge help for anyone with loans, mortgages, or credit card debt. However, while borrowers may feel some relief, savers might face the downside of earning less on their savings. It's a bit of a balancing act, as rate cuts can have both positive and negative effects depending on your financial situation. This is the first time the Fed has cut interest rates since March 2020, back when they had to slash rates to near zero to revive the economy during the pandemic. Rates stayed incredibly low until 2022, when the Fed began increasing them to tackle sky-high inflation. The federal funds rate, which the Fed uses to influence the economy, directly affects interest rates for things like mortgages, auto loans, and credit cards. So when the Fed cuts rates, it's a way of making borrowing cheaper and stimulating the economy. According to Greg McBride, chief financial analyst at Bankrate.com, the Fed has raised rates high enough to get inflation under control, and now they're easing off the brakes to prevent the economy from slowing down too much. For borrowers, a Fed rate cut is generally great news. It means the cost of borrowing goes down. But different markets will be affected in different ways. Take auto loans, for example. If you already have a fixed-rate auto loan, your interest rate won't change unless you refinance. However, new car buyers are likely to see lower interest rates on their loans. Credit cards are a different story. Most credit cards have adjustable interest rates, so cardholders will start to see their rates come down slowly. Right now, the average credit card interest rate is around 25%, the highest it's been in 5 years, according to LendingTree. While the Fed's rate cuts will help lower this, factors like your credit score and income will still play a big role in the specific rates you get. For savers, the downside of rate cuts is lower returns on savings accounts and certificates of deposit CDs. However, McBride points out that in the near term, savers can still earn enough on high-interest products to beat inflation. If inflation stays around 2% and you're earning 3% on a savings account, you're still coming out ahead. He also suggests that now is a great time for savers to lock in higher rates with CDs before they start to drop. CDs can offer predictable returns, making them a solid option for retirees looking to grow their savings. McBride says, now's the time to lock in those higher rates on CDs or high-quality bonds, while yields are still 4 to 5%, so if you've got some extra cash, consider putting it in a CD for steady returns. Finally, if you're looking to make the most of the current financial environment, don't forget about high-yield savings accounts. These accounts can offer interest rates up to 10 times higher than traditional savings accounts. It's a good idea to park your money in these accounts while the rates are still favorable. In summary, while the Fed's rate cuts may bring some relief to borrowers, savers need to be strategic to make the most of their money. Keep an eye on the economy, lock in those higher rates if you can, and make sure you're getting the best returns possible.